So today we're going to talk through the 4 reasons as to why we're not going to enter a recession yet. My name is Brian Cannon and welcome to Markets in 5. So if you watch a lot of my Markets in 5 videos or follow my stock blog online, you'll know that there's a lot of reasons as to why we should or could be in a recession. But I'm going to spend this video talking about why we're not going to be in a recession quite yet. First, when we look at the Fed funds rate, this is a slow-moving indicator. So it takes time to unfold. It takes time to unravel. But you can see, historically speaking, when the Fed cuts rates, generally it's because the market is rolling over. And so there's been a lot of whisper on the streets and a lot of people calling for a Fed funds rate drop, but it can take months to unfold. So, I do think that when the Fed starts cutting rates, that the market's going to be rolling over. And generally speaking, when we have Fed funds rate drops and the market drops, we usually find ourselves in a recession. So, but again, it does take time to unfold. So not yet. The second reason I feel like we're not going to fall into a recession quite yet is that we did have just a recent spike in volatility. Volatility, the VIX, is essentially a measure of fear in the marketplace, and when it spikes, usually it's because the market has dropped. And when it kind of hits its crescendo, when it hits kind of this peak in fear, it's usually a time to be buying, not selling. And so we had a big spike here recently with this recent pull down in the market. And since then, you can see, get my head out of the way, you can see that the VIX has fallen back into a more normalized range. So with the VIX falling, I would say right now, as long as that VIX continues to moderate and to remain low, then again, we're not going to have a kind of a recession or a market pullback quite yet. So maybe we've seen the worst for the time being. The third reason is the trend within the S&P 500. So you can see that, in fact, in the last Markets in 5, I talked about the conditions were overbought. In other words, we were due for a pullback. And so we did get that pullback. Fell down and has since climbed back up a little bit. It's got a little bit of overhead resistance we got to get through to make sure as confirmation that this is going to kind of break out and continue its trek upwards. But as it stands right now, RSI went from being overbought to now oversold and has bounced back to an acceptable range where RSI is now above 50. And, MACD is negative, but we are getting a crossover. So that could be an early sign that, we may recover from this market. Now, we've got, some difficult months. August, September, and October is a very volatile month, but September is usually not a very good month. So we got to watch this closely. But as it stands right now, you can see the market is having higher highs and higher lows. And so as long as that pattern continues, then we feel like we're in the green. But as soon as that breaks down, then it could be the beginning of the recession, of the bear market that I'm kind of awaiting. So in addition to doing Markets in 5 videos, on off weeks, I update the stock market blog. And so I'm going to refer to this to discuss the fourth reason why I think right now we don't have a recession looming quite yet, but again, I think there is one on the horizon. This is the most recent changes to the Fed funds statement, and they discussed that jobs went from remaining strong to now moderated, and then their kind of the focus of their discussions went from essentially focused purely on inflation, which is beginning to drop a little bit, to now both sides of the dual mandate. The dual mandate is both inflation as well as full employment. So they're really focused on the employment numbers. And when we look at unemployment here in the black relative to the stock market in the pink, you can see that when unemployment starts to rise, it's usually a lagging indicator as to the market beginning to drop. So they work conversely to one another. And so after the COVID blip, you can see that unemployment has based and is beginning to rise. The last reading went from 4.1 to 4.3. So, it is starting to rise. And but again, this is a very slow moving indicator. A lot of times they make adjustments to it. Those numbers can certainly be monkeyed with prior to the election. So there's a lot of reasons as to why this will ultimately lead to a recession. So we've got to watch the unemployment numbers very, very closely. However, it's a slow-moving number, and so it could take time to unravel. So in wrapping up, I think the four reasons: the Fed funds rate, the unemployment numbers, the VIX, and the stock market trends, I think are all reasons that could certainly find us in a recession eventually. But those are all reasons I believe that right now will preclude us from being in a recession quite yet. So all hands on deck to watch as we kind of get toward the second half of this year and into probably a crazy election and volatile market. So stick with me, and I'll look forward to seeing you on the next Markets in 5.